For most of the 20th century, a working life followed a standardized rhythm. You spent 40 years at the same firm, and in exchange, the firm ensured you never ran out of money. That era of outsourced responsibility is gone. Under the old system of defined benefit pensions, the employer assumed the mathematical risk. Corporations and governments managed the assets and guaranteed a payout for life, regardless of how the stock market performed or how long you lived. Modern retirement has shifted to defined contribution plans, like the 401k or the SIP. This transition moved the entire burden of investment, funding, and longevity risk directly onto the individual. This chart highlights the expanding timeline of that responsibility. While previous generations only had to fund a decade of retirement, today's savers must plan for 3 decades. And for those retiring early, that horizon can stretch to half a century. Success across 5 decades requires aligning 2 volatile systems: the mechanics of the global market and the psychology of the person navigating it. The quantitative target for a self-funded retirement is replacing roughly 80% of your pre-retirement income. This allows you to maintain your standard of living while accounting for the fact that you're no longer commuting or contributing to Social Security. To manage that drawdown, financial planners have traditionally looked to William Bengen's 4% rule. The idea is that withdrawing 4% of your portfolio in your first year and adjusting for inflation after that provides a high probability of your money lasting 30 years. However, research from Vanguard shows that a rigid fixed percentage often fails when the timeline extends to 50 years. If an early retiree follows a static rule through a prolonged market downturn, they risk depleting their assets while they still have decades of life left. This chart demonstrates dynamic spending, operating within a shaded band. A 5% ceiling limits withdrawals during high returns, preserving capital for lean years. Conversely, a negative 1.5% floor cuts spending during market drops, preventing you from selling shares when prices are low. Mathematical survival requires this level of adaptability. By shifting your spending based on actual market performance, you avoid the trap of relying on a formula that doesn't care about current conditions. A precise withdrawal rate doesn't matter if the system itself is bleeding you dry. Every year, taxes and inflation act like an industrial lathe, steadily shaving away the real-world value of your savings. Sophisticated planners use tax wrappers to counter this. These are legal structures that act as fortresses, shielding your investments from the government's ability to take a cut of your growth. In the U.S., the primary fortress is the Roth IRA. Strategies like the Mega Backdoor Roth allow high earners to move massive sums into an account where the gains are never taxed again, permanently protecting their capital from future legislative changes. Similar structures exist internationally. The UK uses ISAs to protect dividends and capital gains, while Canada's RRSP and TFSA ecosystem allows savers to arbitrage their tax rates, taking deductions when their income is high and withdrawing funds when their tax bracket is lower. The ultimate goal of these accounts is to minimize friction. You are building a system where as much capital as possible remains in the portfolio to compound, rather than being drained by the state. But even a tax-optimized dynamic spreadsheet will fail if the person behind it lacks the discipline to follow the math. This illustrates lifestyle creep. Your spending expands to match every income increase. When a bonus immediately buys a more expensive car, the gap between earnings and savings never grows. Consequently, the absolute cost of this inflated lifestyle outpaces your portfolio's ability to support it. Breaking this cycle requires an intentional budget, like the 50-30-20 rule. By pre-allocating 50% of your income to needs and 20% to investing, you prevent your baseline spending from rising automatically with your career success. The most effective way to enforce this is to automate your investments. By routing money to your portfolio the moment you get paid, you remove the capital before your brain views it as available for discretionary spending. A high-yield savings account provides the necessary liquidity to survive a crisis. Having cash ready for emergencies ensures you don't have to liquidate your long-term assets at a loss during a market downturn. A retirement plan is more likely to fail because of unexamined spending habits than a bad year in the stock market. The math can be perfect, but it cannot account for a lifestyle that scales faster than the wealth supporting it. Sustaining a portfolio over 50 years is a test of both technical and emotional resilience. You have to build the structures that protect your capital from the tax code and the habits that protect it from your own convenience. Audit your own financial architecture. Check if your plan accounts for market cycles, and then check if your own daily habits are secretly undermining the very freedom you're trying to build.